Hello, this is an exercise for week 3. It's an exercise that's about to be delivered in the lecture, and it's accounting cycle practice. For off-campus students, well, for all students that are following this, I will load up into topic 3 a spreadsheet called accounting cycle practice, and when I do that you'll see this information here. It's probably useful for you to print off this page, so you might even stop the recording here. Well, hold on, not just yet. Go and print this page off, and you might also like to print off the answer template. Or alternatively, you could just print off the first page and put your answer straight into the answer template. Okay, so what are you given? You're given a chart of accounts and some transactions, and you're asked to label the general ledger accounts. So we're using T accounts again. I've put a note there that you've not been provided with an opening trial balance. So typically you'd be provided with an opening trial balance. So let me fix that up. You've not been provided with an opening trial balance just because of time. But typically you would have. Record your transactions in the general journal, then post these transactions to the general ledger, then summarise in the trial balance. My suggestion to you is that you have an attempt at this exercise by yourself, then you come back and look how we work through it. Right, so down the bottom of the page there's another link, and it's just outside of the bit on recording, unfortunately, and it's called journals. So we click on journals, and hold on, our first step, let's click on answer template or general ledger, and I will enter in the first step, which was said enter in the totals, enter in the names. So we've got 101, actually it'll probably go cash at bank, account 101, accounts receivable 102, and inventory 103. Now I should talk about inventory. Inventory comes up in a number of different names, like it might be inventory, it might be merchandise, and when you sell it over here they'll become goods because it'll be cost of goods sold. So inventory tends to go under a number of different names, but that's the things you buy to resell. Then the next column over, we have 101 bank loan, and I've said this is a short-term bank loan just so that I can put it in current liabilities as opposed to non-current. Then we have right, let me wipe that out. It is bank loan my computer's just stopped for a bit, right? Bank loan 201, and accounts payable 202, and 20, then salary payable 203. Now you'll notice this is in the form of the accounting equation. I've set this out. Assets equals liabilities plus owner's equity. And owner's equity is going to have components of the capital account, where everything, the only permanent account in owner's equity, capital, which is 301. Then there's drawings, which is 302, 2, and then we move to the revenue and expense accounts. Revenue and expense. And the revenue is sales, and sales is 401, and the expense account is COGS, or cost of goods sold. Right, I'll just put in COGS so that it fits. COGS 501. Now, it could be argued that COGS is really a contra account to sales, but we won't treat it as a contra account to sales in here. We'll just treat it as an expense account. And then we have rent 601 and salaries 602. So that's one way we've got these set up. So revenues equals, assets equals liabilities plus owner's equity, and owner's equity is the capital account minus any drawings plus revenue less expenses. So we look, what's the normal balance of these accounts? Normal balance of an asset is a debit. And remember, debits come on the left. Normal balance of a liability is a credit. Normal balance of owner's equity is a credit. So anything that increases owner's equity will have a normal balance of a credit. So the revenue will have a normal balance of a credit, and expenses, which reduce owner's equity, will have a normal balance of a debit. You would also notice that drawings has a normal balance of a debit. Right, so we've set up in T accounts the general ledger with those accounts in them. Now we're asked to go back and write the journal entries. Righto, the journal entries. So bank loan, $1,000. So we write in a journal. You need to find out which item is the debit. That's the starting point. I can recommend, and I'll take this out in a bit, but watch video, what is a debit. So if this section doesn't make perfect sense to you, make sure you watch this video, what is a debit. And you'll probably need to write that down soon, because by the time I get down here I'll delete it. So what goes in here? Date. I think let's make these transactions June. So June 1, what's the debit going to be? Well, again, we look here. A debit would be an increase in an asset or a fall in a liability. Do we have an increase in an asset here? It's the first question we will ask. And yes, we have an increase in an asset. Cash at bank, we've got $1,000 which we'll put in bank, so cash at bank will be $1,000 debit. And hold on, phone call. I wonder how I pause. I just pause. Alright, back. So now we need to find out what is the credit entry. Just my computer's having a bit of a timeout, and the credit entry is going to be the liability, the loan. So it'll be bank loan, and that's going to be a credit of $1,000. Is it 1,000? Yeah, credit 1,000. And then we need to have a description. Would be being cash received from short-term bank loan. Now, in a lot of the examples we have here, we put in the descriptions, and they won't really add that much because it's pretty obvious by just the nature of the transaction. But as we go on and transactions become more complex, then the importance of the descriptions becomes more significant. So at the moment we're just trying to develop the habit of putting in a description. So there's some important components of a journal. It's got a date, the account name, opportunity to do posting reference, we'll talk about that next, what's the debit or credit, and then what the description is. Now, some other things important, the debits come first, the debits are on the left, and we see here we indent the credit as well. Now, sometimes I've noticed in some items that the credit has not always been indented because there's just been some formatting issues. But let's look at the next journal entry. Purchase $2,000 of inventory on account. So we go 2nd of June. Now, what's going to, whoops, let me put in some bit of space there. 2nd of June. And what have we done? We've purchased $2,000 of inventory on account. So we can see, is there an asset increases? Yes, inventory will increase. So inventory, $2,000. And what's the liability? Well, we purchased on credit, so it's going to be accounts payable. Accounts payable, $2,000. And being purchase of inventory on credit. And you probably put down there who it was from, and could be details like invoice numbers. Right, 3rd of June, paid rent. $500. Right, is there a debit entry here? Well, let's have a look. Is there an asset that increases? No. The only asset we have here is bank, which would go down. Is there a liability that falls? No. Owner's equity. Is there a debit for owner's equity? So, is there an expense? Yes, that's a debit. So here's we've paid rent expense. So the expense is rent, $500, and the credit is going to be, the bank's going to go down $500, so that'll be cash at bank, 500. Now, let's see, being payment of, wonder, let's say 1 week's rent. Well, an important thing to notice here is I've got a posting reference column which I've done nothing with yet. Now that becomes really significant soon, because when we post to the general ledger, that's where this information goes. I know we actually, this happened on the second, oh, they make that the 3rd, did I? Hold on, I've just got some notes here, things I'll have to fix up. So it's going to be consistent. Right out on the 4th of June, we made a credit sale of $1,500. So, is there a debit here? Right, credit sale, is there an asset that increases? Yes, accounts receivable. We've made a credit sale, so people now owe us $1,500. That is accounts receivable, $1,500. And what's the credit? And the credit is a revenue, so sales have gone up $1,500. And this is being credit sales. Now, there's one other entry comes about here, June 4th. And what's that? That other entry that comes about on June 4th? Well, we've sold these items, but we also have items in our storeroom which are now gone, or on our shelves probably, which are now gone. We can go back and see these goods were cost of goods sold. So, what's the issues related to cost of goods sold? Well, do we have a debit entry? What's our debit? Well, of course we have a debit entry. Our debit entry is the cost of goods sold expense. So cost of goods sold $1,000, so those items cost us $1,000, and the cost of goods sold, and the credit entry, do we have a reduction in an asset? Yes, we have inventory. Inventory, those 1,000 items have now gone out of our inventory. And this is reflecting reduction in inventory from sale of $1,500. Now we go to the 5th of June. We have a debit. We received payment for cash, payment for, that should be payment for sale on credit. We received payment for credit sale. What's the credit sale? It was what we'd done the day before, $1,500. So is there a debit item? Yes, our bank increases by $1,500. We've got a payment, so our bank will come up $1,500. Do we have a reduction in a credit? Right, what's our credit? Do we have a reduction in an asset? Yes. What's the reduction in the asset? Our accounts receivable is going to fall by $1,500. 1, 2, 3. Accounts receivable credit, $1,500. So when we look at this, it is just this item here. We record that people owed us $1,500. Now they've paid it, so we record it as being paid. So accounts receivable has now gone to 0. The 6th of June, the owner withdrew $200 of cash. What's the debit? Well, drawings is a debit. So drawings, $200. What's the credit? Here's cash at bank, it's gone down $200. Now, you'll notice lots of other things that have come through here on various exercises, drawings, cash at bank. Like here's an example, or here's one I was just thinking of here. This is an example of an increase in an asset and a decrease in an asset. Here we have an increase in an asset and an increase in a liability. Increase in an asset and an increase in a liability. An expense and a reduction in an asset. An increase in an asset and a revenue. An expense and a reduction of our asset. Final entry, well, reflecting. Actually, I'll leave out journals here just so these all fit in on this page. Not leave out journals, I'll leave out descriptions. So I just highlight these descriptions here. We should have a description after every one, but I'm guessing by now you've got the hang of descriptions. I know, and the 7th of June, what's the 7th of June? We owe for $400 for week's salary. This is a bit tougher one. This is to do with accruals, which we've not yet done. So I've just put this in to introduce it, but you probably won't have mastered that yet. What is the debit here? Well, salary expense is the debit. Salary expense, $400. What's the credit? Well, our bank hasn't gone down. In fact, we've incurred a liability. So we're just recognising the fact that we owe someone $400 salary, but we've not yet paid them. So that will be salary payable. The credit will be the liability of salary payable, $400. Righto, there's the journal entries, and you might like to print them off. That could be handy if you've done that. and then we'll go to the answer template. Well, I'm going to put up a solution, so I'm going straight to the one called the general ledger and hope I can remember what the transactions are. Right, well, let's post the first transaction. Is cash at bank, $100, $1,000, bank loan 1,000. Righto, cash at bank, a debit, $1,000, and bank loan $1,000. Now there's a few more things we need to look at here. Cash at bank is number 101, bank loan is 201. So back to the journals, the posting reference, we can now signify we've posted this item by writing 101 in the posting reference. We can signify we've posted the bank loan by writing 201 in the posting reference. Now also, each of these journals would have a number, and we'll call this G1, that's General Journal 1, and just so they stand out, and well, here we'll go, we'll call this G2, G3, General Journal 4, G4, G5, G6, G7, and that one will be G8. Just again, so they stand out. Well, my computer is having a rest for some reason. Maybe I can pause this for a bit. Righto. Right, now I haven't really left the space over here in the general journal. It works out okay here, sorry, in the general ledger, but we would here put the journal reference somewhere, and the journal reference we can see for this one is G1. Now they're all not going to work so well as this, because these two line up, so that's G1, that works pretty well for us. Let me make this a bit thinner, and this a bit thinner, and I'll put row in here, make that G1, Righto. The next journal entry is inventory $2,000 and accounts payable $2,000. So we go debit inventory $2,000, debit accounts payable $2,000. Now we'll go back and record these postings. They're 103 and 202. So we can say this has been posted. When we write 103 in there, it tells us wrong one. We write 103 in there, it tells us it's been posted to account 103, and we write in here 202, tells us it's been posted to account 202, and the journal reference is G2. Now again, you'll notice the accounting equation stays in balance. Well, look, the assets are 3,000 equals liabilities 3,000. Now, the next journal, hold on, I've got to stop again. Oh, thank you, Bernie.
Came up, so I thought I'd bring
Greatly
it up for you.
appreciated. Yep. Let me go to the next one. Rent, where were we? Rent $500 debit, cash at bank $500 credit. So rent, $500 debit, cash at bank, $500 credit, and we can signify these are posted account 501 and account 101, the journal 501 and 101. Again, this we write this in only after we've posted them. So, and then we do the reverse, so we've always got an audit trail, That was item G3. Whoops, I stuffed that up. G3, I'll put that down as a credit instead of a debit. Well, we could. That's one of the things I could leave, and we could find that out when we do the trial balance. But I see time's not going to be there to do that. So let's move on. G4, accounts receivable $1,500, sales $1,500. Accounts receivable $1,500, sales $1,500, and that's account 102 and 401. 102, 401. Now this is G4. Now G4 works in well there, so what we'll have to do here is go G4, G4 to signify the one on this side, and G3 to signify the one on that side. Righto, the next journal. Cost of goods sold, the one that goes with that, 1,000, and inventory 1,000. Righto, cost of goods sold. Righto, what have I done here? I've made a mistake. I can see I put rent $500, I put in cost of goods sold. So I need to go back and acknowledge that it goes in there. And take that out of there. And take that out of there. I hope some of you worked that out beforehand. Righto. Then the next item was cost of goods sold 1,000 and inventory to follow 1,000. Now cost of goods sold, so we go back here and we can tell we did post that to the wrong account. Rent 501 when rent is 601. So I've now fixed that item up. Now down to cost of goods sold is 501 and inventory is 103 to signify we've posted them, and this is journal G5. G5. G5 and G5. Now we're on to G6. Cash at bank $1,500, accounts receivable $1,500. So we're paid $1,500 for account receivable, and our cash at bank is $1,500. We know that is journal entry G6. And we know that is journal entry G6, so we can go back and they are, the debit's 101, the credit's 102. So debit cash at bank 101, that's been posted. Accounts receivable 102, it's been posted. Drawings was $200. Now that is going to be a debit because it's come out. Drawings $200. Cash at bank $200. And this becomes G7. And this is G2 on that side and G7 on the other side. We just have one more item to post. Salary, we need to go back and say drawings. We have posted drawings, that's 302, and we have posted the cash at bank, which is 101. And then the last journal we need to post is salary expense, which was $400 debit, and that is salary payable, $400 credit. Now this is a G8, General Journal 8. That's General Journal 8. Now, one thing you'd notice if you added all of these up, that our general ledger would stay in balance in terms of the accounting equation. Now the final thing to do is to finish off some of these accounts. So we add this up and we've got $2,500 on this side, and we have $700 on this side. So what do we then do? We therefore take $700 off this side to give us a closing balance of $1,800. So there's our closing balance there, $1,800. This has a zero closing balance, and here we just take the 1,000 off. So this is when we close them up at the end, so that we have a closing balance of $1,000. And here, that's closing balance as well. That's nothing. There's the closing balance there. Closing balance there. That closing balance is right. All these other closing balances, there's not much we need to do with. So now we're right to do the closing trial balance. So closing trial balance, let's have a look. These are the accounts we had. Let me put that in. Now on this side we'll have debits, this side we'll have credits. Now the debits, cash at bank, 1,800, accounts receivable 0, inventory 1,000, now a credit, bank loan 1,000, accounts payable 2,000, salary payable 400, the capital account, there's nothing in it as yet, revenue, sales is 1,500 credit, and we have cost of goods sold 500, rent expense, no, cost of goods sold, clearly having problems with cost of goods sold today. Cost of goods sold 1,000 equals rent expense 500 equals rent expense 500 equals salaries 400. Now when we add these up, they should balance between the debits and the credits, and they're out by $200. So this is why we have a trial balance, to find out where we are out. What have we done wrong? Well, should really say, what have I done wrong? $4,900. Right out, all these accounts seem to be posted correctly. Now let's see, G1 has got 1,000 and 1,000, that works. G2 is 2,000 and 2,000. G3 500 and 500. Let's have a look at G8 and 400. So G4 1,500. Where's the other side of G4? G4 1,500. Oh, it's accounts receivable. It should be over here. Yep. G5 1,000. inventory, and cost of goods sold, G6 1500 and 1500. Right. Is there $100 I put on the wrong side? That's not likely. Are all these accounts on the right side? Salary payable. Aha! Drawings, $200 we've not put in. So we can see there's one item not included, so we now put in drawings of $200 and it will balance. And that's one of the reasons why we have a trial balance. So it helps us identify if we've got something entered incorrectly or we've left something out. And from here we can produce financial statements, and I won't go into that now, it wasn't something asked for, but the item undo the items from here up, I'll give them a different colour. Those items are what's called our permanent accounts, and these are our temporary accounts. Our balance sheet will be made up of these, and our items down here from, not drawings, leave drawings out, items from here down will make up our income statement. And then we take to the profit or loss we've made in the income statement and combine that with drawings to produce our statement of changes in owner's equity. Alright, that's the end of that exercise. Bye.